Hi friends, welcome to our Tax TV channel. Pascal Saint-Amans, who stepped down as the Organization for Economic Cooperation and Development's tax chief this month, is leaving at a time when what is arguably his greatest achievements. No one can deny that Saint-Amans, a master political operator, fundamentally transformed the OECD's tax division and its mission. In his 15 years with the Center for Tax Policy and Administration, most of which was spent as its director, the OECD went from coordinating a handful of experts who tinkered around the edges of international tax policy to setting the worldwide agenda for a new digital economy.
Saint-Amans, who came to the OECD in 2007, had been put in charge of the Global Forum on Tax Transparency and Exchange of Information. That group marked the first time many countries came together within the OECD on an equal footing, according to Grace Perez Navarro, who has worked at the OECD's Tax Bureau since 1997. Saint-Amans helped build the Global Forum up into an incredibly effective international effort to address tax evasion, said Perez Navarro, who now leads the Center for Tax Policy and Administration. The financial crisis, she added, was the big thing that Pascal was able to capitalize on.
The Global Forum, and public sentiment following the crisis, created an environment that allowed Saint-Amans to drive changes on a global scale. He did this first through the rewrite of the international tax rules known as the Action Plan on Base Erosion and Profit Shifting, or BEPS.
BEPS project. The BEPS project, launched in 2012, was a massive, 15-point plan to shut down widespread tax avoidance by forcing large multinational companies to claim profits in the jurisdictions where they have actual operations. Work on BEPS was carried out between 2013 and 2015. Unlike previous guidance projects, which were usually bottom-up, generated by the technical experts from the OECD's 36 member countries, BEPS came from the top down. Saint-Amans had convinced leaders in the group of 20 nations, which included Brazil, China and India as well as the European Union countries, to buy into a coordinated effort with a clear goal in mind.
As he described it, the OECD after BEPS went from working within the box as the guardian of existing international tax rules and treaties to thinking outside it. The global financial crisis in 2008 clearly showed that globalization without tax regulation, or without revision of the tax framework, doesn't work, Saint-Amans told. Governments, as he saw it, had two options for restoring sovereignty over their taxing rights: enact measures unilaterally that would protect each country's base, or agree to a common framework.
I think what has prevailed is the more coordinated manner, even though we see unilateral measures here and there, Saint-Amans said. The BEPS work operated at a speed and on a scale unlike anything the tax world had ever seen from the OECD. Negotiations, which formerly had taken place among delegates exclusively from member countries, now included representatives from the much wider group of nations that became known as the Inclusive Framework. While guidance in the past could take as long as 10 years to complete, most of the BEPS action items had a strict deadline of 2 years.
The project's outcome was a series of recommendations for changes to treaties and transfer pricing rules, along with what was clearly its biggest accomplishment: a global reporting regime requiring large multinationals to disclose to governments the profits earned and taxes paid in each country of operation.
The arm's length principle. The country-by-country reports, along with other BEPS recommendations, including changes to the transfer pricing guidelines on intangibles ownership, effectively shut down cash box arrangements, in which entities with few or no workers are set up in low-tax jurisdictions where they earn huge profits. The BEPS project also did much to ensure that all income from large multinational groups was taxed somewhere in the world. The work that remained, according to Saint-Amans, had to do with the reallocation of taxing rights between countries.
BEPS 2.0 The OECD had also made a conscious decision in undertaking the project not to reconsider the arm's length principle as the way to allocate taxing rights between residence countries, where companies have headquarters, and source countries, where activities take place through subsidiaries. Those two leftover pieces, the digital economy and the arm's length principle, fit pretty well together, Saint-Amans said. The issue highlighted in Action 1 on digital was a question of reallocation, and the arm's length principle, the transfer pricing guidelines, are about that.
The OECD had convinced 137 of the 141 countries in its inclusive framework, the wider group of jurisdictions involved in BEPS and BEPS 2.0, to sign off on both pillars. In early 2021, the Biden administration dropped the safe harbor condition and the global tax talks revived. By that time, the project, known as BEPS 2.0, had evolved into Pillar 1, a plan to reallocate more tax rights to countries shortchanged by the traditional requirement of a physical presence to trigger taxation, and Pillar 2, a global minimum tax.
A sinking ship? Since that time, the European Union, which had hoped to be the first mover on Pillar 2, has been unable to adopt the minimum tax as one country or another. Most recently, Hungary has blocked the unanimous approval needed for tax law changes. And while the US recently passed a 15% corporate alternative minimum tax, it doesn't meet the basic definition of a qualifying minimum top-up tax in the OECD's model rules. It is not a sinking ship, he said. A more fundamental problem is that Pillar 1 is supposed to take effect through a multilateral convention, which would have to be adopted like a treaty by the US Senate. According to Saint-Amans, this criticism boils down to the usual refrain from business, that the changes he sees as necessary, which involve connecting different tax regimes, are complex. Please subscribe.